The S&P 500 fell 1.5% today, most of it coming after the Fed raised rates 25 basis points, and most of that coming after Fed Chairman Powell started his press conference. So very negative reaction that produced some rare technical signals. We'll take a look at that today. We'll also take a look at how the equity market reaction compared to other markets reaction and which one of those we should believe. So we're going to talk about that in today's video, as well as a trade idea for a stock that if we do continue to fall broadly, we can take advantage of that decline, but limit any gains to actually a small losses, to a small gain if we do bounce up to the upside. So let's go ahead and get started. Today is Wednesday, December the 19th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500, which produced its third oversold cluster in a row, so getting a cluster of clusters here. And in that time frame, in that three cluster period, we have broken below 2,600, that important level that we've talked about before. And obviously we have 2 days left in the week, but the big capitulation type move here today, almost 100-point range, over a 10-point range on SPY, as we'll see here in a second. Very, very big decline, obviously. And really the past week, we had this move on 12/12 a week ago today, and then dropping, as I mentioned, from 26.51, 150 points essentially, to get down and touched below 2,500 here today. So strong bearish posture, obviously, with the intermediate line down. You got to have that for the cluster. Oversold sentiment, short-term sentiment still strongly oversold in the reversal zone. Again, definition of a cluster there. You take a look at the Dow Jones Industrial Average. It also has its third cluster, with all three lines. Near-term line barely staying below 20. The NASDAQ Composite, also near-term line is the one closest to rising. It's gotten two clusters in a row during this weak decline, and then of course the Russell is got four oversold, and again all four of these include market sentiment. In fact, this is so many these oversold clusters here, so back to back. Again, the Russell's been the most bearish out of all these indexes. This is typically the case when things fall. You can see it really started to fall right here after peaking here on September the 20th. Then it had this decline, and from that period of time, we're looking at a 22% drop. So from September 20th, and that's even down a little bit from its all-time high. So the Russell 2000s had a significant decline during this time frame. If you look at the weekly charts for these, and again, we're not done with the week, but you can see again, as I mentioned before, a weekly cluster, oversold cluster on the S&P 500. Same thing on the Dow. It's actually the third, or excuse me, would it be the second week? No, the Dow is not there yet. It's close. It's not there yet. It's the NASDAQ Composite here that's had 2 weeks in a row of oversold clusters, and then the Russell 2000. Looking at its weekly chart, you can see also 2 weeks in a row of oversold clusters. So significant pullbacks, pull downs here, producing some rare signals. Again, if you go to the S&P 500 and you go back as far as we can to see when's the last time we've gotten weekly clusters on the market forecast, and it's all the way back to this time frame, back in 09. And again, during what would be a beginning of a bear market, if this is indeed the beginnings of a bear market, not just one of these pink periods like we've seen since 09, then it would be March of 08 that we had a weekly cluster. Made a return move back up to the 200-day moving average, got another weekly cluster, made another return move, and then that's when things fell off a cliff and the fall of that year, and that's what ended the bear market, when we fell off the cliff. So that's where we're at right now. So this kind of shows again how rare this signal is. And then if you look at the monthly charts, you can see again we have an oversold momentum line, which is not very often we get that. The intermediate lines above 80, we're still a week away, so big grain of salt there. If you look at all the big candles on a monthly when we've had the big declines, just look at all of them across this chart on the 20-year period. You can see none of them closed at the low of the month. So all of them now, all of them produce long lower shadows when you had the big ranges, the big candles, relatively speaking. We always came off of those lows. So we still have a couple weeks left, well, basically a week left of trading here in December, and see if that pattern holds, or if we get the first significant monthly candle without a long lower shadow. Where would that long lower shadow get to? You can see, some of these here, the low at 2603 and the close at 2711. So that was a 100-point move off of that low. Here is 2532 up to 2713. So almost a 200-point, about 180-point move off of that low. Here's a pretty decently sized candle. We went from a low of 1812 to a close of 1940, so over 100 points. You look at some others like these here in 2008. The worst months of the Great Recession, and we went from a low of 840 up to 960. So even then, up 140 points. And then the next month in November, a low of 740 up to 850, so 150 points. So that was at 1,000 versus being over, being at 2,500. So those are significant candles there. You can see back over here, again, a low of 775, a close of 911, another 100+ point move. So you get the idea, right? You get the idea that we've seen these long lower shadows at the end of a significantly bearish month that have been about 100 points or more. So we've got about a week, and not even really that, because Christmas Eve is a half day, Christmas is a full day, and then usually the week between Christmas and New Year's is a very light volume period. So we'll see if we get the same patterns playing out again. Okay, before we dive into some other charts, a reminder, subscribe to our YouTube channel. Mouse over our Market Scholars logo right there. Then click that red subscribe button that pops out. Also, click the thumbs up icon down below the video. That tells us you want us to do the video again. Comment down below on what stood out to you. What did you learn? Or what was something you got out of tonight's video? Scroll down and comment on that below. Join our daily Market Outlook email list. There's a link popping out in the top right corner of your screen. 185 stocks today showing up in today's watch list that I post. Well, you have to scroll to the bottom of the email, but 105 oversold clusters in the market forecast. That's the biggest number I've ever seen in doing this watch list. So to get that list, make sure you subscribe to our email list. Follow me on Twitter for more content like this throughout the day. Join our community, our Facebook community that we created for the Market Outlook video on Facebook. All right, if you're watching our video here on our blog, remember you can participate in our Market Outlook forums with this link on our Market Scholars website. To do that, you have to subscribe. You can do that for free by clicking this image in the top right corner of your screen. There's our calendar for the rest of the week, actually for the rest of the year, as I will be taking the following week off between Christmas and New Year's. And of course, remember to click on this heart here. That tells us, like the thumbs up, that tells us that you want us to do this video. Again, clicking on that and like tonight's Market Outlook tweet. Also, click this image that takes you to your Facebook page. You can like and share tonight's Market Outlook post there with friends that you think would be interested in this. Remember, you can also share it on sites like LinkedIn, as well as on Twitter and Facebook. All right, as I mentioned before, this pullback that we're getting is a third down to 2,500 from 2,940, so about a 440 point move. Is a 38% retracement of the move we had coming off of that early 2016 low point. That move was a 23% retracement of the bullish move off of the 2011 low point. And that pullback, was a 38% retracement of the move off the 2009 low point. So you can see, how these kind of pullbacks work. See, none of these were bear markets. They were significant pullbacks. In fact, if you look at here, let's change the MACD down here at the bottom to show the current price relative to the 200-day moving average. If you look at the MACD back in 2011 at its lowest point was 134 points. Get my calculator up here. 134 points, and we were trading right around 1140, 1130. So what did I say? 134 out of an index that was trading right around 1120. Let's say 1120. So we're looking at about a 12% decline away in 2011, away from the 200-day moving average. That's how far we were there. And if you look at now, the MACD is 219 points, and we are at 2506. Oops, 2506. So we're actually only 8%. So we're not down as much this time to a 38% pullback below the 200-day moving average as we were back here in 2011. So it kind of, again, puts a little context into this move. Again, the reason why it's so dramatically, down now is because the move that preceded it was so dramatically bullish. And that's, you look at it from an annualized basis off of that low point up to the high that we had. I mean, that's if you look at the numbers up the top in the middle, percent per year, that's a 24% annualized return over essentially almost 3 years, almost 1,000 days. So 24% annualized return, whereas this move that produced the 38% Fibonacci retracement off of the March low point essentially got us up. It was a 48% move over 784 days, 48% per year. Again, that's why that's why we dropped so far down to the 38% Fibonacci retracement and so far below the 200-day moving average. So, again, these pullbacks, the more significant the rally is, the bullish move is on a long-term basis, the more significant the pullback will be, as we've seen previously during this pretty much almost 10-year secular bull cycle here that's had these brief pullbacks in 2011, even smaller in 2010, but the main one in 2011, and then again in 15 and 16, and as of right now getting it here. And again, biggest number point wise, but not as big percentage wise as we were over here, and we were a lot further away from the 200-day moving average on a percentage basis in August of 2011 during the credit downgrade crisis. The Dow Jones, of course, finally getting its death cross. The NASDAQ pushing further away from its 200-day moving average, and same with the Russell here. So pretty bearish moves there. You take a look at the 3 green arrow chart, and you can see again the extremity of today's move. 3 red arrows, obviously, and you look at the 2-line versions of these indicators. You can see the MACD again almost as low as we were back here. And if I were to again change that MACD down there and compare where we are now to where we are to the 30-day moving average here. So 30-day here. Again, we are about as low away from the 30-day moving average as we were back here. We had a few more volatile days before that bounce up, and same thing with the stochastics. So it kind of just again shows the extreme lows. We see, the other patterns, other charts. You have the linear regression, of course, still trading below that second standard deviation channel. Each new day pushes that channel lower, but we keep going lower below it. So extreme lows there. You look at the Bollinger bands here. Go to SPY. You look at the Bollinger Bands, and they're pushing up to levels we saw back then as well in late October. That date, October 29th, is we'll see that date crop up here a few more times. You take a look at the you look at the RSI. We're back below oversold levels again on the RSI, and then of course the CCI, another oscillator. You can see. Also at below extreme levels, not below negative 200 though. This time did get below negative 200, so we've got a monstrosity of a bullish divergence potential showing up with the CCI, and of course with an extreme oversold RSI. Finally, the last oscillator we use quite a bit here is the DMI, and as I mentioned before, the negative DMI a couple of days ago getting above 40. This one not. So again, potential divergence setting up there, but again shows how bearish we are to get that line up above 40. It doesn't happen too often, and usually that's our extremes, right? Our extremities, except for when you have those initial surges. The initial surges, of course, you'll see them match up with the surges in volatility too. They get them up. It's those secondary moves that we are in right now that we've seen over here before. That when we got that bearish, we've again set that low point after a pretty decently sized move to the downside there. The only reason why this move, it doesn't look like this move in March, is because we didn't go up. We can see we went up, didn't go up as much off of that low point as fast, and so we pulled down further. But still, you can see the significance of that bearish move in March, similar to what we're getting here right now. All right, now here's where things get interesting. You can see the volume that kicked in to extreme levels here. Here today on the Fed meeting, and the 10-point range that we had today, 10 plus points between 259.40, 249.35. So over 10-point range. The last time we had a 10-point range during this decline was October 29th. And then you can also see too between 280 and 250. That's a 30-point range for the 4 weeks. That's over 10%. And the last time again we had an over 10% range was October 29th. Right there. We also had this move did not quite get to a 10% plus range for the 4 weeks, but this one did. This one got a little bit over 10% when we got to actually this date, the 8th, and then finally the 9th. Those ranges, as well as on this day here, that low point got us both times to 10% moves, and the last time it happened here most recently was 1029. So you can kind of see what happens when the 4-week range gets so significantly high. Of course, the volume at 215 million here. The trading range, like I said, over 4 points. Now we're getting the ATR up over 2% because that's what 10%. 1% is 250. So we're looking at a 4% range today. And the volume at 215 million is well off the charts of the 52-week range for this average. So very, very high levels in all of these. What did not spike to extreme levels is the VIX. Well, it did spike to an extreme above 105%, but not to that surge level. As I mentioned previously, I mentioned that surge, when you get above 115%, that's when you have those initial surges, right? The DI negative gets really high. And then we moderate, and this is the level that gets above 40 like we're getting right now. So volatility, as much as volume jumped up to extremes and the ATR hit a 4% move, volatility didn't quite match that. It actually stayed kind of right where it's been for the last week or so. It didn't even budge hardly at all today. So interesting lack of a move. Again, not getting above 26. Someone said this is like one of the to see the Dow basically fall 10% in the matter of a couple weeks and not break 26 on the VIX. This kind of shows again that people who buy these puts for protection for a living do not feel the need for it nearly to the extent as they did even back in early February, when after that move we had that big time bout of volatility that lasted all the way basically to the beginning of May. And of course you can see it on a relative basis there. Another interesting sign that we didn't see today on this extreme move was the trend. See, the trend got up to a really, really high level back here in December the 4th, obviously. So again, the trend measures how much volume on the down issues there are relative. It looks at the ratio of advancers versus decliners versus the ratio of advancing volume compared to declining volume. A bigger trend means we had an extreme amount of volume on your down issues compared to the actual number of down issues. It tends to be kind of exhaustively bearish, but also, again, you see those at the surges. When you don't see it, it kind of, again, puts into context just how bearish we were today. And again, we didn't see very much of a move at all today on the trend. You can see what it looks like on a weekly chart here. A couple of weeks ago in December, we did finish up close to 2. We pulled back down, but still at a really high level. Anything above 1 is bearish. Obviously you look for extremes in these levels, but today you can see down to 1.2. Go back to the daily chart, and not nearly as bearish as it could have been. So volatility in this volume is kind of telling you again that today's move was more extreme than what some of these other markets would suggest and tell us. In fact, we'll talk about this here more in a moment, but the futures market for the Fed funds basically didn't change at all going forward into 2019. So the market is pricing in something that none of these other markets really even either cared much about or saw compared to what the stock market saw. All right, so that being said, to summarize, obviously the market should continue to be strongly bearish from an intermediate posture standpoint, but within the strong bearish posture, combined with oversold short-term sentiment, suggests we may be getting a pattern not only on a daily chart but also on a weekly chart that we just don't get very often. A weekly oversold cluster. I believe in the email that gets sent out, if you subscribe to our email list, as I mentioned before, the watch list tonight has 185 stocks in it within the S&P 500 that are showing oversold clusters. That's a significant number, and again, for all the time that I've been sending out that list, I've never seen it that high. So again, you can look at that as a contrarian signal, because usually other peaks in that particular indicator, the number of S&P 500 stocks with oversold clusters have signaled extreme selling conditions that have led to bounces. So will that be the case this time? Again, we'll see if that pattern repeats itself. And what do you think? Do you agree with that outlook? This idea that we're extremely oversold and we might end up forming the long lower shadow on that monthly candle, as we've always done at least in the most recent past, 20-year past. Do you agree with that or not? So if you don't disagree with that, there's a poll that's popping out. Hit that poll and then hit either agree or disagree. If you click disagree, scroll to the very bottom, comment on what you see or what you see that I didn't bring up that would suggest that what we currently have could devolve into a lot worse before it ever gets any kind of short-term bounce. At least short-term bounce. So again, click that poll and comment below. All right, so let's take a look now at what's driving the markets. Obviously today was the Fed meeting, so no surprise there. Interestingly enough, the market, because of the big move, kind of the suggestion that the Fed kind of failed in communicating. It's got the stated goal of being a lot more transparent with its policy decisions to avoid days like today on any kind of statement release. Apparently, the market was not expecting what it got today, and it did what it did. All right, and you can see going into the meeting, we were actually positive in all these equity asset classes before the S&P and emerging markets and small caps especially all dropped post FOMC statement, and you can see that's when the press conference started there. All these other risk classes dropped. You have high yield dropping, gold dropped, with the dollar actually rallying to small gains. It was actually down significantly for it before the FOMC meeting announcement was released. Long-term bonds jumped up significantly on the news. Crude oil, interestingly enough, was up really big, 4% at one point in time. 4% at one point in time after the FOMC statement, finishing up 2.25% on the day. That's a pretty decent move. Now, keep in mind, go back to that October the 3rd peak, to see how everything has performed since then up until now. Crude oil was down over 38%. So, of course, it's going to be bouncing from extreme oversold conditions. The S&P making a run towards a 15% decline. You can see the safe haven asset classes up here at the top, long-term bonds. Now I wanted to show you this. I did tweet this out earlier today. This is on the rate hike odds for December, the end of December. So how many rate hikes we're going to get in 2019. Now you notice this is the first time that I've seen in quite a while here that we have a column to the left of, now it's only 1.6%, so it's not significant, but the fact that there is anything there is more than I've seen in quite a while. And again, that's the odds of a rate cut from where we're currently at. Here's all the rate hike odds. Here's the rate cut. Here would be one rate hike in, so we got about a 35 plus that 8. So we're looking at about a 44% odds of one rate hike in 2019. We have about a 9% odds of a rate hike. A 9% odds of a rate hike and to have a second rate hike. So, and again, that's what Powell said in the press conference, is that they're planning on 2 rate hikes in 2019. That the growth forecasts are great and economy looks great, and he tried to really pump up, how bullish the economy was. But you notice here, in fact, this is actually this is the FOMC meeting because of the timing of the video here. We actually had dropped. Right, that number was over 10%. It had dropped to under 8%. It's back up a little bit here in the after hours, but you can see very, very. I mean, the markets haven't priced in anything differently. The stock market's pricing in the fact that we'll get rate hikes in 2019 that will lead us to recession. The futures market's not pricing in rate hikes at all for 2019. I don't know if it will show historical for. Show us the historical numbers here. Here is again where we're at currently. So this is the current mark right here. This is again for 2019. So if the red line shows us no rate hikes at all for 2019, that's the current value. This would be one rate hike, and you can see that was the highest, and now it's dropped down. And of course, 2 rate hikes in 2019, which was kind of the expectation. I mean, look at, that's the dark blue line. It's all the way down here. In fact, it's lower odds that we'll get 2 rate hikes, which is what Powell was trying to, Chairman Powell was trying to drive home to people today. The futures market is saying there's less of a chance of that happening as there is of a rate cut by the end of next year. Right? And no rate hikes at all, and actually 1 rate cut of 25 basis points. There's higher odds of that happening than there is. And I tweeted out that what's worse than a Fed that raises rates so fast, faster than is needed, that they produce an inverted yield curve. What's worse than that is a Fed that the markets don't believe, right? So the stock market believes it, and the stock market basically, as most people know, is the worst market in terms of not being too bright, right? It's usually the bond market and the forex markets tend to have a lot more credibility in terms of reading the signs better than the equity market. A lot more participation, broadly speaking, in the equity markets than there is in these other, and not as much money, right? A lot more money involved in fixed income and currency markets. So equities tend to be driven by sentiment and headlines a lot more than some of these other markets are. So the futures market here for the Fed funds rate is not telling us what the equity market is telling us today. So which one is wrong? Well, usually you would, if you had a bank on one of them being wrong, the best bet is always to bank on the equity market reaction being wrong, and the fixed income or futures market, in this case for the fixed income market, being the correct response. The one reason why is you look at the here, let me go to the 1 year. This is the inflation expectation rates. Here, we'll go to 5 years. So you can see the inflation expectation rate was down below 1.5% when they started to raise rates. They took off a month here in 2016. They only had they had the one in December of 2016, excuse me, after they had that run up. Then they took off a month. They took off this month in June in 2017. I ended up with 3 rate hikes in 2017. And then obviously you now have had 4, but you notice we don't have rising inflation expectations anymore. In fact, since October, since the stock market peak, we've gone from 2.25% down to barely above 2%, and that continues to fall. So a sign that the inflation, that these rate hikes are not needed, and again, why the futures market is not buying what the Fed chair was selling today. Now, if you look at how the markets are performing, so no surprise that energy had a little bit of a bounce. Materials was also up there. You can see financials was doing well, and then they dropped sharply along with everything else. Utilities held up, and staples and real estate held up. In fact, again, if you do the time frame to October the 3rd, right, from the time that the market peaked and we started to have this decline, those particular areas are still bullish. Real estate now is showing a small negative. Staples is only down 4%. That's why a lot of you that follow Brandon's DGI classes aren't nearly showing the same pullback that you see going on in the broad market as a whole. And then, of course, the utility sector is up 2.5%, while the market itself is down 14.25%. So you can see energy stocks down nearly 25%. So big, sharp declines there. But, again, for some perspective on that, as the market itself is down for a 23% Fibonacci retracement, if I were to go back to that February, let's say February the 1st of 2016, off of that low point, right? Then you notice there's our stocks that have made the biggest move. In fact, from that period, you can see from that low point, and it actually would be what 211. So let's change the time frame to reflect that. So we'll go back to 211 here. Now let's do a weekly chart so it's not so busy. You can see technology stocks off of that low were up 90%. They're still up 59% over a almost 3-year period. 59% gains. You can see where technology is. You can see staples here. There it is, up 4% for that time frame. Energy stocks 6.4%. Utility stocks up 20%. Real estate stocks up 17%. With the pullback, materials now up only 25%. And of course, industrials up 30%. They've been down the most. But you can see at the beginning of the, by the time we got up to this peak, technology was up, financials were doing really well, discretionary was doing really well, industrials, the weakest areas were the safe havens, and they've fallen a little bit, but that's why they haven't fallen very much, because they didn't really rally very much during this bullish move. And even with this pullback that we've had, you can see the gains that some of these sectors are still showing on a long-term basis off of that low point. Even if you didn't get in right at that low point, even off of, say, this low point, you're still getting some pretty decent gains. All right, one stock that's really struggled here today was Intel, and it was actually holding up decently, but you see it's struggling to get through this big significant volume node and closing below a lot of lows here. So a pretty bearish close today. Getting down to its lower Bollinger Band, heading into an area of lack of volume support. You look at its market forecast chart for Intel. You can see the momentum line dropping again. You can see how bearish that close was, below a falling moving average now. Look at its long-term chart, the 15 200-day moving averages. We made a return move after the death cross. We're now potentially bouncing down from that. You look at some of these other indicators here, like the Bollinger, or we already looked at the Bollinger Bands, the DMI, INTC. You can see it's a negative line bouncing up more than it's been during this whole time. So heading into a bearish mode. And then, of course, the 3 re-narrow chart, INTC, and you can see the 8 and 17-day crossing below the 30, so we're starting to diverge away to the downside. MACD crossing below 0, stochastics crossing below its moving average. Decent volume today. So again, we can look to do a bearish vertical spread where I buy, at the money here, and then, I can go out to the 43 and keep my cost to $1.21 roughly, depending upon where I get filled in. I can cover that cost by selling a 43. Now I have a credit, and I can do that actually a couple more times here. I'll show you why. See, right now, if I did it right now, I'm getting $32 of credit for $767 of buying power according to this account. So, not quite 10%. If I sell a few more puts here, let's do a couple more and get up to 4. You can see now I'm getting $341 of credit for $2,000 of buying power effect. So I'm getting, what that'd be, about a 15% return on the credit, and that's my worst case scenario, right? If I analyze that, you can see if we do continue to go up, if we bounce up for whatever reason, then that's what I make, 15% on my risk. If we go down, then I go from 346 down up to 642, and then you can see where my break even is. Well, I put that on the chart. There's that break even on the chart. So we'd have to, there's some pretty significant support down here around 43. Well, hey, if we get down to 43 and we have support, then I can make, 30% return on my risk. I have a high probability of making, that decent return, between 15 and 30% return on my risk. So relatively high probability trade, using this strong support in this area over the last 52 weeks as a potential area. And if it keeps going down below that, of course, I'm willing to take a $346 loss on this. So that would be down to this level here. And if I were to put that on the chart, that's how far down I have to go before I take a loss equal to what I was trying to make, at least a minimum what I was trying to make, $346. So that kind of gives you an idea of doing a bearish trade, and if it does do this kind of inverted head and shoulders pattern, if we do bounce up as a market on the whole, then I can make 15% on my risk. If it doesn't, if it keeps going down but holds support, I can get up to 30. If it keeps going down below that, then I'll take a loss that I'm comfortable with according to my risk management rules. All right, so that wraps us up for today. Now I want to hear from you. So go ahead and click that link that's popped out in the top right corner of your screen. Let's go to the forums and marketscholars.com. Let me know what you're thinking. What do you think about tonight's market outlook? What questions or comments do you have for me? What questions or comments do you have about something I didn't cover in tonight's market outlook video, or that you would like my take on, or any other market scholars take on as well? Remember to subscribe to our YouTube channel. Click the thumbs up icon. That lets us know you want us to keep doing these videos. Comment on the videos on what stood out to you, what you got out of it, something you learned in today's video. Follow me on Twitter for more content throughout the day, and join our community, our Facebook community that we created for the Market Outlook. So that being said, again, have a great rest of your evening, everybody, and we'll see you all next time.